Hello viewers, welcome to Clear Tax Knowledge Series. Today's discussion on the checkpoints for filing of annual returns. And under GST, annual returns has a major role to play. I want everyone to really get that the annual returns is the last opportunity for anyone to, if some mistakes are there, to get it corrected. What we are going to see in today's discussion is on the legal provisions for filing of the annual returns and the reporting of outward supplies, the tax liabilities thereon, reporting of input tax credits, reporting of reverse charge liabilities, the adjustments one needs to do in the GSTR-9, what are all the probable issues and how you can resolve them. These are the various aspects that we are going to discuss in today's session. Now, you might have various doubts about the GSTR-9 per se, whether the GSTR-9, can it be corrected, can it be revised, what are all the corrections that I can do, all those things would be there. Feel free to interact. If you have any questions, put it in the questions. I would also take up the questions as we go. However, in the interest, I am going to pick the questions at the end so that we can see that what are all being happening and how you can make the corrections. Start with, let's understand the legal provisions of the GSTR-9. This we call it as annual return, section 44, read with rule 80. Annual return is given under section 44 subsection 1, which states that every person who is registered other than input service distributor, TDS, TCS, the composition taxpayers, non-resident taxable persons, casual taxable persons, these people, they have to file the annual return. Composition taxpayers, there is a confusion. There is an annual return GSTR-9A. Today's discussion, we will be restricting it to the regular filers who will be filing GSTR-9. These people shall be furnishing an annual return and which may include a self-certified reconciliation statement. I have highlighted it. So GSTR-9C, which was all along been certified by a chartered accountant, now the ownership has been moved to the SSE, making it as a self-certified reconciliation statement. Is it good or bad? Keeping it aside, the ownership has been casted more on the taxpayer. Earlier, at least he could have taken the shelter, okay, someone has audited, okay, someone has reviewed. Now it is casted on the taxpayer to reconcile the values of the supplies which are declared in the return furnished for the financial year with the audited financials which has been furnished, right? So both your audited financial statements and this needs to be reconciled by the taxpayer themselves. So what are the returns the taxpayer is expected to furnish? There are different types of annual returns. For a composition taxpayer, we call it as GSTR-9A, which I am not discussing today. GSTR-4, which is annually filed, is only left with the composition dealer. So the portal currently is not made 9A available. Unless otherwise there is a switchover and there is a requirement of 9 and 9C. But what is being for the discussion today is GSTR-9. And the e-commerce operators have an obligation to file GSTR-9B, which is also we are not discussing. Though section 44(1) says that everyone has to file, there are some relaxation. The relaxations are that people whose aggregate turnover exceeding 2 crores, okay, is mandatory. Those not exceeding 2 crores, whose turnover is less than 2 crores, it is optional to file. And 2 crores to 5 crores, annual return is mandatory. The reconciliation statement, which is called as 9C, is not required. Those whose turnover is exceeding 5 crores, both 9 and 9C are mandatory. There is another presumption that once I file 9C, nothing else is required, but both are mandatory, both are required. Let me give you a glimpse of GSTR-9. Though I am not discussing the GSTR-9 today, the discussion for today is on the checkpoints. What are the checkpoints that you will have to check before you file your annual return? And for this, it is very important you understand the structure of the annual return. Annual return is divided into 6 parts. Very beautifully drafted document. It is divided into 6 parts. Part 1, which talks about the basic information about the SSE. Part 2 talks about the liability. Liability could be on account of outward supply and the reverse charge inward supply. So it is further split into 2 tables. Table 4 is the turnover on which there is a tax liability. Table 5, there is turnover but there is no tax liability. These are the 2 things which are available. The next thing is on input tax credit. There are 3 tables. Table 6, 7, 8, part 3 of the annual return talks about input tax credit. Table 6 is the input tax credit availed. Table 7 is the input tax credit reversed. Table 8 is the reconciliation between the ITC availed and GSTR 2A, or so called 2B now. Obviously, after the liability and input tax credit, the next thing one should be knowing is the net taxes that is paid. So the part 4 is the tax paid details, which comes in table 9. Please note, ideally annual return should have got closed between part 1 to part 4. However, error is human. We might make mistakes, and those mistakes are corrected in the subsequent tax periods. We do not have a concept of revising a return which is filed, nor we do not have a concept of splitting of the tax payment pertaining to current period and prior period. That's where we have circular 26, the last circular of 2017, giving us an explanation how do you correct the mistakes that has occurred in GSTR 3B or GSTR 1. Now these corrections, if this spillover happened to the subsequent financial year, that is, error happened in financial year 2021 is corrected in the financial year 21-22, how do you report it in this annual return is carved out in your part 5. Then the government was expecting additional information. The additional information is given in part 6, other information, table 15 to table 19. The fundamental query which people get is, before filing of GSTR-9 or as they are filing GSTR-9 and they are doing the reconciliation, the fundamental query they get is, I have made an excess payment of taxes in GSTR-3B, or I have short paid the taxes in GSTR-3B. I have paid the taxes correctly, but the turnover in my GSTR-1 or GSTR-3B was wrongly reported. Turnover was correctly reported, but it got interchanged. The IGST got interchanged between CGST or SGST, or vice versa. Or you could have come out with a new thing that, okay, this is what is missed. This new discovery, can the new taxes be paid through GSTR-9 now? Or I have made an excess payment, can I claim it as a refund? There's so much of input tax credit that has been missed. Can I avail it now along with GSTR-9? or the registered taxpayer has reversed the excess ITC in 9. Does it mean the reversal of input tax credit? No. Can we deal with all this? Is the primary question people get. I would like to draw your attention. After you file your annual return, there is no impact neither on your electronic credit ledger, cash ledger or liability ledger. After you file your annual return, there is no change to your liability ledger, credit ledger and the cash ledger. It means annual return is an information return. You cannot use it for payment of taxes, nor claiming of refund or availment of input tax credit or reversal of input tax credit. Now you may get confused that we had this option called DRC03, so that's what we were doing. Your statement is perfect, but please note you are making the payment of taxes or reversal of credit under DRC03. The action so taken or would be impacted is reported in the annual return. Through annual return, you are neither making the payment of taxes nor reversal of input tax credit. This aspect has to be kept in the mind very clearly. Now let's begin with what should be the checkpoints for filing annual returns. Let's start with my outward supply, and this takes the predominant shape in filing of the annual return. Most of the assessments happen around outward supplies. Now, where can you find the supply in your financial statements? Your supply can be anywhere in the financial statement. It could be on the credit side of the P&L, debit side of the P&L, asset side of the balance sheet, liability side of the balance sheet, and outside your financial statements or the P&L. Let's look at one by one. The most obvious thing which we all know is the credits in the P&L as the supply. However, there are some exceptions. I'll just come into a couple of slides later, but let's come to the rest of the points. Debit side of the P&L is also you have to scrutinize. You have to scrutinize for, are there any reimbursements you have claimed? For example, you bill out of pocket expenditure while raising an invoice, could be on transportation, packing, commissioning or anything. These out of pocket expenses which have been collected, has it been credited back to the expenditure which is there on the debit side of the P&L? If so, you have to carve them from the P&L and add it back as a supply for your purpose of GSTR-9. So you are recasting your P&L for the purpose of your GSTR-9. What would be there on the asset side of the balance sheet? Whenever you sell off an asset, whenever you have sold an asset, what you report to your P&L is profit or loss on sale of asset. But what is there as a supply for the for the purpose of GSTR-9 is the gross value of the asset which has been sold. GST needs to be discharged on the gross value of the asset which is sold. It's a different story, 18 subsection 5, which asks you to reverse the input tax credit which is of the balance period, whether or not you have availed input tax credit on sale of an asset. You got to discharge GST on the gross value of the supply that you have made. Okay, what can be there on the liability side? We all know whenever an advance is received for goods or services, there is a liability. Thankfully, notification 66/2017, the central tax, has reduced the liability. Time being, temporarily they have suspended, not the time of supply provisions it has been removed, but advances for goods, time being it's been taken out. Still, whenever you are receiving an advance for your services, you still have a liability. So whenever you receive advance from the customers, it is presented in the liability side, you will still have a liability. So your supply for GST, which is ideally what we think as the turnover or the income, could find in any of these places. Okay, what is that outside the financial statements? Friends, we all know financial statements are carved out basis a financial transaction. If there is no financial transaction, which means you cannot attribute with a number, it cannot find a place in the financials. For example, I have moved stock from one branch to other branch in another state, one GSTN to another GSTN. From the purpose of books of accounts, it's not a supply. I am not going to treat this as a sale and purchase. It's a single P&L which is there in the financial statements. But for the purpose of GST, this is a transaction which is outside the financial statements. Or you have given some the guarantees and there is a commission which is charged and it is offset, various another things, something which is outside the financial statements. All your schedule 1 transaction which would be deemed as a supply, even though you have not collected any money for it, you still need to add it. So first checkpoint for your outward supply is to include all these transactions as a levy, and you should include it. Furthermore is declare the revenue and make an assessment. When I say make an assessment, firstly include all these schedule 1 transactions which is deemed supplies, stock transfers, cross charges, employee recoveries, all these things you might have declared as a revenue or not. Please check that. Second thing, not just checking that the revenue is correct, whether it is classified correctly, what is the HSN and what is the rate of tax that you have adopted, what is the value that you have adopted should also be checked. The time and place of supply for it should be checked. Next, the debit notes that are raised is at par with a tax invoice. So whenever there is a change in the rate of taxes, please raise the debit notes, especially when the rate of tax is moving up. Now, when the rate of tax is moving down, you will apply section 14 appropriately and raise a debit or a credit note. However, the interest for the delayed payment of taxes would still be applicable in case if it is attributable to a supply. The only exception that is carved out for no interest for the debit note is if it is attributable on account of late interest collected because the customer has paid late. Again, credit note issued will reduce the supply. Section 34 has given the instances where a credit note can be issued. So carefully look at all these credit notes. Will it pass the test of section 34? Also, there is a time limit. The credit note shall be issued and report, not just issued and report in the GSTR-1 by September of the next financial year. And thankfully, the September due date for this financial year 2021 would be falling in October. You can make a review, and if there are any corrections to be done, you can make those corrections and report them in the GSTR-1, which needs to be filed for the month of September. In case if there is a tax treatment in change in rate of taxes, you should make those changes, because whenever you do not know anything, you would have paid taxes either at IGST at 18%, you can make those corrections now. Couple of checkpoints. If you are a proprietor, if you are earning rental income from immobile property which is outside your business, you should include it for the purpose of reporting. However, if that rental income is attributable to a residential property and used as a residence, there is no GST. Still, it needs to be reported as an exempted turnover under table 5. But however, if it is a commercial property, even though the quantum is less, GST liability would be there, because you are a proprietor and you have registered for GST. Not only the business income, other incomes also have to be included. So please include that. Next, There could be situations where you are a salaried employee and you are getting Form 16, TDS is deducted under section 192, no worries. But sometimes you might be under payroll, but for some reasons you are saying that okay, let me take it as a consulting revenue. TDS is deducted not under 192 but under section 194J or C, whatever the appropriate nature it is. That income, you might be thinking that okay, I am there on the rolls but not under the payroll, but it is as a consultant. That has to be looked into. So that treatment has to be looked into. In case of a partnership firm, if a partner is registered, whenever a partner is bringing an asset into the firm as a capital, for example, instead of bringing cash, I have given my laptop, which as my capital contribution. I am a registered person. When I purchase the laptop, I have availed the input tax credit. This laptop is now brought into the books of the partnership firm as a capital contribution. In that scenario, one has to make sure that this is reported as a supply in the books of the partner. In the partner books, it would be treated as a supply and you have to pay GST on it. So this is another issue many people miss out. Then on dissolution of a partnership firm, if the assets have been withdrawn instead of capital, these assets would be treated as a supply in the hands of the firm. Due care has to be taken. And the partner's salary and interest is outside the purview of the GST. The remuneration, profit appropriation, these are all appropriation to the profit. These are outside the purview of the GST. So you can take an appropriate adjustments or accordingly. Next, the special focus on these items. It would be available, it would definitely be available in some of your cases, that the GST impact on discounts. Now when I say discounts, the discount could be in the nature of a financial credit note issued by the supplier, or it is an incentive. Now how do I bifurcate? And please note, this is a common issue where most of the suppliers, manufacturers giving some credit notes without GST being there. I as a recipient, should I reverse the input tax credit or should I pay GST on it? If so, what is the supply? What should be the rate of tax at which I need to pay? Okay. There seems no questions. No problem, we'll continue. Now let's take as an industry very known to us. Let me give an example of, let's say, a mobile phone. Now a mobile phone dealer is wanting to return some of the stock to the distributor. Reason, there is a new model has come, the old model is not moving out. The distributor would say, I would give you an additional incentive discount when you sell it. So I as a dealer sold to the customer 15,000 rupees phone is sold, let's say 12,000 rupees. Because of this, my distributor has given me a credit note, let's say out of 3,000 loss, he said I should be bearing 1,000, he will be bearing 2,000 rupees. He has given me a 2,000 rupees financial credit note. Now this he has given it as a discount or whatever be the terminology. While I make the subsequent payments, I have adjusted it. This 3,000 rupees which is there, 1,000 I have absorbed, 2,000 credit note, I have adjusted it and paid the short amount. While finalizing my books of accounts, it was showing the 2,000 rupees payable in the books of to the supplier, by which was there as a credit note. I have reversed it back to my books of accounts either as a other income or a reduction to my purchase cost. How should I treat this for the purpose of GST? Most of the people have not paid GST, stating that it is a financial credit note. But if you look at section 15 subsection 2, this is a value addition to the supply. My sale, something has been paid by the buyer, something has been paid by the distributor. So it should be added to the value of supply. Then what are the financial credit notes which fit into this? Let's say I have achieved a target of 1 crore. I have to procure 1 crore purchases. I have done it. Owing to it, my distributor has given me, say, additional 1% discount. Additional 1% discount. Now this additional 1% discount which has come, he has given me, let's say, a financial credit note of 1 lakh rupees. Again, I don't need to make any payment. Now he did not give me a credit note under section 34. Had it been a credit note under section 34, no issue. But this is a credit note without any GST. There is no per se the terminology for financial credit note. We use this as a financial credit note since it is affecting only financial books and not affecting the GST. How do I treat at that point? Those discounts, even though you have reported as your other income, there is no supply by me as a dealer to the distributor, hence there wouldn't be any GST. So you got to be very careful. Sometimes income is booked, maybe for GST, may not be GST. Forex gains is not going to be affecting your GST. Profit on sale of asset will not be affecting your GST because you are paying taxes on the full value of the supply. I have written off something as a bad debt. Owing to bad debts, I could not raise a credit note. I did not reduce my liability. But when there is a recovery from the bad debt from the customer, I would still make a follow-up and recover it. When such recovery happens, I will treat it as another income. That other income which is recovered need not be reported as a supply under GST. Now, where do I report these? If this cannot be reported as a supply, these can be a non-GST supply. The next one, penalty, damages and forfeiture. Penalty, damages and forfeiture. Now, I from the recipient side, you got to be very careful. If I have an obligation to pay, let's say 10,000 rupees for a procurement which is made, there was a faulty material which I has received. I said I don't need the material. Supplier said, okay, instead of 10,000 pay me 9,000, that's fine. Now that 1,000 rupees I have, which I am levying it as a penalty or damage or a forfeiture, would it suffer GST? Here it is a litigative statement. You got to look at the terms of the contract, whether it is a condition to a contract or it is a consideration to that contract. Now, if it is treated as a consideration going to the contract, you will still have a GST. So please look at all your supplies fitting under various heads and report it. Now, having arrived at, okay, this is my supply, my turnover is matched. I looked at all these things, my turnover is matched. What is that I should be doing next? Is look at the taxes. Look at the appropriate taxes. When I say taxes, not just payment of the taxes, say let's hypothetically 18% is the tax. Not just making payment of the tax. Have you paid the right tax? What do you mean by right tax? CGST, SGST and IGST. So that bifurcation is what you should do. Let's take multiple scenarios, starting with the correct tax that should be levied is CGST and SGST. Even in the invoice it is CGST and SGST. By mistake I have disclosed it as IGST in my GSTR-3B. Oh, okay. Then this should be corrected. Have you corrected it? Yes, I have corrected it. When did you correct? In the same financial year. Then perfect. So you have nothing to do. So the summation of your GSTR-3B has taken care. So the correct information you will be disclosing it in your GSTR-9. Okay, I have made the correction, but this correction happened. The correction happened in the subsequent financial year. How did it happen? I have paid lower CGST, SGST and paid higher IGST. In the next year, I have reduced the IGST and paid CGST, SGST higher. The option, my suggestion is do this tax adjustment in your table 10 and 11. So show that okay, you have paid the extra taxes and the differential taxes. 10 is if you have paid in the subsequent year, 11 if you have adjusted in the subsequent period. Make these adjustments accordingly. Let's take a scenario that you have not paid. You paid the taxes, but you have not made any adjustments. So you have to ideally report the correct taxes that needs to be paid in table 4 of GSTR-9. So when I say correct taxes, you have to report, you will be reporting CGST and SGST in GSTR-9 table 4. Now technically you have not paid, so table 9 will show that there is a difference. This difference you paid through DRC03. This difference you paid through DRC03. Then you may say, are you asking me to pay extra tax? Of course, but it is not going to be extra tax. Claim a refund of IGST. Since it was not required to be paid, you have paid. You have 2 years timeline from the date of the payment of the taxes to claim the refund. Please go ahead and make a claim of a refund. That's the right way of doing it. Next, vice versa. CGST as IGST. I'm not discussing, the same thing would be applicable. Whatever I have explained for CGST, IGST, the same thing would be applicable. Next comes treatment of advances. The advance is received in financial year 1920. Invoice has been issued in financial year 1920. Do I need to do any adjustment in 3B? That is, I did not report it as advance. I did not report it as advance in GSTR-1 and everything. Since the invoice has been issued in 1920, no issues. You report it directly in table 4. Please note, if you have not reported in 3B, not paid the taxes, not reported in your GSTR-1, then while finalizing your GSTR-9C, create this additional liability, make the payment so that you can adjust it in the next financial year. Perfect, right? So the tax treatments have been understood, the turnover has been understood. Now this turnover is generally there at the corporate level, all the GSTNs put together. So how do you deal with it? You split first the turnover from the books of accounts into April to March, each GSTN wise, GSTN 1, 2, 3, you split it. You have stock transfers, appropriate stock transfers, add it. Like how do you build your working papers for the purpose of GSTR 9 and 9C? At the time of assessment or the audit under 65, the officers are going to ask you. And this year, the responsibility is more to ensure that even more accurate workings you are building it. Having gotten the correct turnover, this number, whatever you are seeing in this current slide, this number you now split it into rate wise. How much is 5%, 12%, 3%, whatever the rates that are applicable, split it into rate wise, both taxable value and tax amount. Then if something is not applicable, is 0 rated, without payment of tax, exempt, nil, non-GST, you split it as another thing so that your total turnover is matching. You have computed the tax liability. In the earlier slide, you have computed how much the taxes have been paid through 3B. So taxes paid information is there, tax payable information is there. What is that we have to do? If there is a shortfall, that shortfall needs to be paid. The additional liability needs to be paid through 3B. So you compute both the payment paid and the payable. This shortfall has to be paid through GSTR DRC03 using cash. Please pay it through cash only. Now, why cash? The explanation also clearly says you have to pay it through cash because the ITC balance which is currently there, this is on account of This is on account of the ITC accumulated during April, May, June, July. The liability is pertaining to March. So since it is not an ITC of that, so GSTR 9 and 9C payment through DRC03 has to be done through cash. I think now you got a fair idea what are the things you have to check finalizing your liability and finalizing your taxes that needs to be paid. Let's move on understanding or freezing your input tax credit. Fundamentally, your input tax credit has to be analyzed with your expenditure. When I say expenditure, both revenue and capital, predominantly revenue expenditure. The expenditure is segregated into two aspects, something with GST, something without GST. And those which are with GST, how much is eligible, how much is ineligible. The expenditure without GST, you find out, are you purchasing from a composition dealer? Is it exempt? You purchase from a registered dealer but it is exempt, or it is not a GST item. Or very importantly, is reverse charge applicable for such supply is what you have to look into it, right? Now, a checkpoint, again an analysis, a quick review of all the line items that is there for you. You analyze whether are you eligible for input tax credit or not. There are questions that you have to ask, whether you have tax invoice, whether you have received the goods or not, whether it is appearing in your GSTR 2A, have you paid to the vendor within 180 days, like look at 31st March closing creditors, do an aging of it. This credit is not blocked under section 17, like we know blocked under section 17 means that it is not relating to motor vehicle, food and beverages, goods which have been lost, or employee health insurance, life insurance, or construction of an immobile property or something penalties paid. It shouldn't have been a credit which is blocked under section 17. Next, we have rule 4243 where there is a common credit. That common credit has to be reversed according to in the proportion of exempt and the taxable turnover. Have you reversed accordingly or not? Do a check of it. Rule 36 sub rule 4 where the additional credit one can avail. It was 20%, later became 10%, now 5%. Ensure that you are complying with this percentage. That's point number 1. Point number 2 is this was only a temporary adjustment. Doesn't mean that by the time filing GSTR-9 you still have a credit which is short, which is still owing that okay so much of the credit that needs to be paid. If still the liability exists, and like when I say liability exists, my GSTR 2A is only 100 rupees, I have taken 105. By the time you finalize your GSTR 9, this 5 rupees would be a liability, because section 155 casts the responsibility on the taxpayer who is availing input tax credit to fulfill the conditions of 1616 and prove that the credit is genuine. That 5% is not an eternal credit. Some more points on input tax credit for you to check is, first and foremost, generally people who are under inverted duty structure, they have availed some credits pertaining to input tax credit who have not reversed. When the notice came in, there are different treatments that are happening. So I have brought in some of the points. Whether the reconciliation is it necessary? The answer is yes. People ask, okay, in Arise India Limited, Delhi High Court said that okay, the recipient is genuine, taxes have been paid by him to the supplier, material has been received, e-way bill exists, the taxes have been paid within 180 days, can he avail the input tax credit? The answer was affirmative, but of course that still needs to be tested. In the case of GST regime, I would still say that fingers crossed that okay, if you are availing it, you should be lucky if something doesn't happen, but I would say that it is a risky credit. Make sure you do the reconciliation. There is a time limit to avail. In fact, this session is in apt, we are in September. Whatever is the missed out credits, please avail it within the time limit that has been specified under 16 subsection 4, which is the September of this current period. The question that comes up, whether this would be applicable for import of goods or not, since this is the levy which is happening under the Customs Act and not GST. If you look at the input tax credit definition, the input tax credit includes the taxes paid on customs, so it better avail all the input tax credits without any timelines, without any lapse of the timeline. So by September, make sure you avail all the input tax credits. Okay. The table 12 of GSTR-9C has like a bank reconciliation, how much was the liability there in the books, how much is availed in the next period, how much you are claiming it, all those things are available. So do that reconciliation. There's a question people get, if the place of supply is not in my state, can I take the input tax credit? Answer is no. ITC should be reversed. Should it be SGST and CGST or both? In my view, both input tax credits have to be reversed. Then there is a breakup of input tax credit into input services and capital goods. Should this breakup be done? Yes. Table 6 expects you to do the reconciliation of this breakup. Okay. Now, after doing that, match your credits. How much is there in the portal? So it is there in the portal showing, when I say portal, take it 8A. 8A of GSTR-9 can be downloaded into an Excel. Take the balance which is there in table 8A and match with it, whether it is properly there or not. Those which are matching, no action to be taken. But those which are not matching, so see if you can follow up with your supplier and get it availed. And those which are there only in the portal, see whether it was missed in accounting, has it been accounted in the next year, or it is an ineligible credit. So accordingly you can report in your 8E, 8F of your GSTR-9. And this also have to be reconciled with the books. How much have you availed in the current year goes to table 7J. This is a checkpoint for you. So if you have availed in the current year, when I say current year, financial year 2021, it goes to table 7J. If you have availed in the subsequent year, it goes to table 13 of GSTR-9. And you have availed it but reversed in the subsequent period, then it goes to table 12. That will match with the net ITC that you have to take it in the books. This is on the forward charge credits. What about reverse charge credits? Reverse charge credits, we all know there is two things, 9.3 and 9.4. So 9.4 is currently available only to real estate industry. Other than that, majority is 9.3. Even if I see 9.3, there are various entries under 9.3. So that is where now you have listed out those expenditures. So we have segregated expenditure into two categories, with GST and without GST. We looked at how to deal with GST. Those expenditures without GST. Now see whether any of those expenditures fitting under this. Is it a GTA cost, legal cost, sponsorship service? You have given sponsorship to someone, or you have given some service, you have availed some services to the government. So all those things, please look at it. Whatever which is highlighted in the blue color are something you have to check, because people forget that okay, it is the section something like this exists, and they wouldn't reconcile. If you pay taxes in time, you will get the input tax credit. Even reverse charge goes by the time limit of 16 subsection 4. If you pay it late, then you will have a problem. So reconcile everything, and after looking at this expenditure, you look at whether you have paid it or not. Payment of the reverse charge is reported in table 4G of GSTR-9. This payment is shown as a liability. After paying, I will avail the input tax credit. Such availment of input tax credit should be matching with your table 6C and 6D of GSTR-9. Now for some of you it is appearing that okay, too much of math being discussed. Don't worry, this recording is available. You can always come back and see what are these table numbers and should it be matching or not. So the input tax credit you are availing on account of reverse charge should be lower than or equal to 4G, and why lower, sometimes there would be an ineligible credit. Now your table 6C and 6D has a reverse charge liability on account of registered and unregistered. So that's where we got some exemptions under notification 56. I'll discuss in a while, but however have a check that in my GSTR 2A I can filter a column called is it under reverse charge. If the reverse charge is yes, that much should be there as a liability in your table 4G. Okay. After understanding my liability and the input tax credit, there would be some adjustments that happen. What is the adjustment? I have paid the taxes, but the taxes are paid in the next year. So if the taxes paid in the same year, you will be reporting it in table 4. If the taxes are paid in the next year, you will be reporting it into table 10. And if still there is some liability to be paid, you will be reporting through DRC 03. Such payment of DRC 03 will be coming into table 4 of GSTR-9. So these are the checkpoints one needs to have before finalizing your outward and inward. Now what we have covered is part 2 liability, part 3 input tax credit, part 4 is the net taxes paid through cash and credit, part 5 is the adjustments that have happened in the subsequent period. Now there is a part 6, the major thing where you have reporting of HSNYs and everything, all those things are there. So what about those things? Now there has been some simplification in the reporting by virtue of notification 56 by 2019, and this has been adopted for the subsequent year by 79 bar 2020, and the relevant notification for the current year is notification 30 bar 2021, wherein the title of it has been changed. Okay, what are the changes that are there is, while reporting in your table 4, you have to ensure that if there is a movement upward and a downward, amendments that you have done. What do you mean by amendments? Table 9 of GSTR-1 is meant for correction of the wrong returns. So the GSTR-1, table 9 of GSTR-1 is the upward and downward movement amendments. Those amendments are also expected to be reported in GSTR-9 accordingly. It was finding to be challenging. So the government said, it's okay. Amendments, debit notes, credit notes, you can net it off and report. Then exempt, nil and non-GST, you can net it off and report as exempt. Even credit notes and debit notes for table 5, you can net it off and report. When it comes to the input tax credit, when you come into input tax credit, so the input tax credit on capital goods, please report it. Input tax credit on capital goods, please report it. You have no option. See, that would facilitate the assessing officer to know if the ratios are not matching. Like generally, how do I find out what is the profit that is reported by the assessee? How much is the tax paid by input and tax paid in cash indicates the profit ratio. But if the taxes have been paid through ITC, if the ITC is on account of capital goods, I need to eliminate finding out the profit ratio. So it is mandatory that you report the input tax credit on capital goods. However, between inputs and input services, if you are unable to do a bifurcation, it can be reported under inputs. So please be careful of it. Then RCM, how much of the RCM is on account of from the registered purchases and unregistered purchases. So the portal said that you can club it and report it. Again, the reversals on account of various rules between 7A to 7H, which is that if you are unable to reverse bifurcate it, no issue. Just that if any reversal is pertaining to trans credit, you report it under trans reversal only, leaving that rest can be done. Then 8A to 8D, if you are unable to give it, upload it along with your GSTR 9C as a reconciliation. Then the part 5, which is on the subsequent year adjustment. Liability is mandatory. ITC, which is table 12 and 13, has been made optional. The last of that, which is major part 5, is table 15 to table 18. So if you can bifurcate and report it, you can very well report it, but otherwise also it's optional. My personal suggestion, even though wherever it is optional, please report them to the extent is possible. It gives you clarity, it gives you additional checkpoint, especially on table 17. HSN wise reporting acts as a reconciliation of rate wise reporting, which you otherwise have to do and report it under table 9 of 9C. So use these options and reconcile them so that you get a better clarity on what are the checkpoints that you need to follow before you file your returns. With this, we have come to the end of the discussion. I will go over the questions, if any, in the chat box, and you can ask me any questions if you have in the chat box. Let me look at the questions that are coming up. Video, this is Priyank is asking about the video link. This is anyhow there in the YouTube. You can always save this video link and you can always look at it. Okay, any other questions by the viewers? Of course, if the question is asked now, I will be taking up. Otherwise, you cannot put a question at a later point. It can come in the chat, and sometime in the chat it can be replied. We still have a couple of minutes to take up the questions. Okay, so on this note, we come to the end of the session. I conclude the session, and